Good afternoon, traders and investors. Will back here with another one. Well, guys, the most hated rally just continues here, marching north here as the bulls continue to gain more and more ground here, guys. And we call it the most hated rally because a lot of people are in disbelief of what's happening as interest rates are said to be higher for longer currently. The economy is said to be slowing down and the jobs market is slowing down as well here, guys. But what we do want to remind you on the channel is that we have been calling this for a while now, guys, right? We were calling that the Fed was most likely bluffing and for inflation to continue to trend down towards the target here. Now, a lot of people may be saying, well, there is a recession potentially looming for next year here. But the fact of the matter is, guys, that the economy just isn't showing the signs of it yet, right? GDP, I'll remind you, for the last quarter was very strong and the jobs market is getting more and more tight. Let's remind ourselves of the two things here that the Fed is closely monitoring in terms of their mandate here. Number one, they want to get inflation closer to their 2% target, something that they've been doing a very good job with at really increasing interest rates hard and fast for the better part of the first half of this year here, and now slightly tapering off. So they've done a great job of raising rates, and that has induced a little bit of a panic in the consumer here. And you've been seeing this pretty much all year and for the past 2 quarters, most specifically here in terms of company earnings here. The consumer has been pulling back on their discretionary spending, and that's exactly what Jerome Powell wants. They wanted to induce fear into the consumer here, and that's why you got a lot of headlines saying that we're potentially going into a recession here as the Fed is squeezing the economy with high rates. But that's not what they wanted to do at all. They just wanted people to slow down their discretionary spending. There was a lot of pent-up demand here after 2020 and 2021 with a lot of free money, a lot of printed money as well, and a lot of people that just wanted to get out and live life and buy things, right? So there's a lot of pent-up demand. And now that we've gotten through a lot of that pent-up demand and a lot of consumer savings, people are now trending lower in terms of the amount of money that they spend on experiences and also goods. You've seen it most specifically in the drop in the goods purchases here over the last few inflation reports, guys. Except from energy, right? Everything else was trending down over the last couple of CPI reports, and that's exactly what you want to see here. So inflation is going in the right direction as the Fed has basically scared people into the thought of a recession here, which is bringing down inflation as itself as they don't go out and spend enough money. They're now back to modes of saving here. And that is also benefited with the fact that a lot of major institutions are providing 5.5% savings rates on savings accounts. So a lot of consumers are deciding instead of spending money now, like they have been doing in the past couple of years, now starting to save money again. That's why inflation has been coming down as well. And the second mandate by the Fed here is obviously for full employment here. So a lot of the times when they were raising interest rates here at the beginning of the year and also in the middle of the summer here, well, the jobs market was very, very healthy. Unemployment was very, very low, and there was a lot of jobs. Every single job report that came out, whether it was a normal jobs report or a non-farm payrolls report, was showing that there was more and more jobs opening and more people looking for work. Well, that has now reversed here a little bit here, guys. In the past 2 jobs reports, they've come down a little bit below our expectations here, and that is a good thing. So now you have a little bit of a rise in unemployment and less people looking for work. And what does the Fed want? The Fed wants to stimulate max employment. So you have your CPI going like this downwards, which is what the Fed wants through its increase in rate policy here. But what you now have is the amount of jobs and amount of people looking for work is also slightly trending down. So what will they potentially need to do next year as the economy slows down as a byproduct of the increased rates and as the job market tightens up and tightens up and tightens up? Well, there's only one tool that they have, guys, and that's playing with interest rates and playing with the supply of money. So it's very possible if we delve into potential a deflationary aspect, because now we've been getting disinflation, meaning that the rate of rise of inflation has been coming down. But if we get deflation in goods and services, that's not what the Fed wants. They want positive inflation year over year. And if we get deflation, and if we also get a jobs market that becomes way too soft for the Fed, what can they do? Well, they're potentially going to have to turn the money printer on and start decreasing rates in the middle of next year. And this is what has triggered this massive market rally here. You can see it. The yields have basically peaked here. The 10-year yield has pretty much peaked back in late October here, now nicely trending down. And the 20-year yield as well, which were basically speculatory yields, right? The 10-year and 20-year is basically bond traders speculating. They have both been coming down beautifully here. as the market is now realizing that the Fed is very possibly threading the needle here, guys. So this is just a very quick update on why we've gotten a very substantial market rally. It is basically Wall Street calling the Fed's bluff of having to keep interest rates that high for that long. So they are calling the bluff, and they're saying that interest rates will most likely come down early to mid next year here, guys. So that is the reason for the rally. Now, we've got a lot of things to cover in today's video here. We're going to cover, obviously, our major indexes. I do have a couple earnings reports for you guys. We're going to go over Lowe's. We're going to go over Autodesk as well. And lastly, we are going to cover John Deere, which had their earnings this morning before the open here. So a lot of earnings to cover. We're going to run down our major indexes as well. As you can see, the markets did fairly well today. And lastly, our major tech names too, and quickly my portfolio at the end of everything. So I hope you appreciated that intro recap as to the reasoning behind this rally. Now, as for the day, SPY up 0.39%, QQQ up 0.41%, and broad market rally once again. You can see it here on the heat map, guys. Very nice broad market performance, save for a few big tech names, NVIDIA and Tesla trending slightly to the downside. But as a whole, guys, very, very beautiful broad market performance on the market today. Healthcare and financials really holding up their own. That is what you love to see. And on the one-day relative, guys, you can see that all major sectors pretty much in the green, except for energy. You like to see energy come down. That is going to help inflation more and more here. And on the 1 week relative, you can see that we're performing very well for the week, as most of your major sectors are in the green. 1 month relative as well. Very, very, very positive, guys. Technology, 1 month relative, almost up 11%. So it's been a heck of a rally so far in the past 3 weeks, guys. So without further ado, before we get into more technical analysis here, and the technical analysis will be quick as not much has changed. We're still looking for the same things. So we'll go through that quickly. But as of now, let's cover a few earnings, shall we? So first, we're going to cover Lowe's. So as you guys know, we did cover Home Depot on the channel here a few weeks ago, and this earnings report was largely the same here. Lowe's as a whole has been consolidating pretty much in this area, about 190 all the way down to 171 for the better part of the last year and a half. Why? Because they pulled forward a lot of demand here after our pandemic years, right? A lot of consumers were out and about doing a lot of home renovations and buying a lot of things for their homes and backyards and potentially cottages and secondary properties as well. So they pulled forward a lot of demand here in 2020 and 2021 here as interest rates were low. And you guys know when you're doing home renovations or purchasing big ticket items like new flooring, new appliances, and all big ticket items, well, a lot of people choose to finance them. Well, now when financing rates have been virtually high for the past year at this point, you've been seeing a slowdown in discretionary spending demand, and a lot of home renovations have also stalled as well, as your housing market rotation and turnover has also come down. So you guys know housing market has not been the best as of lately, and that is a byproduct of your high rates. So Lowe's, although they are in a very decent buying opportunity zone here, PE ratio is fairly low here at 15.26. Their earnings was decent, but their guidance remains fairly weak here. They don't see a return in discretionary spending for the consumer for the foreseeable future as long as rates are high. But we did have a beat here on EPS, and we did have a slight miss on revenue here as well. So all in all, a bit of a mixed report, and you can see right here, Lowe's tumbles as retailer echoes the Home Depot warning on big ticket spending. We saw this with Home Depot, and it's no different for their competitor Lowe's here, right? So unfortunately, down a little bit. Group revenues, Lowe's said, fell 12.8% to 20.47 billion, missing analyst estimates of a 20.89 billion tally. So a slight miss here on the revenue. Same-store sales fell 7.4%. That is very similar to Home Depot. Home Depot also had, I believe, a 5-6% decline in same-store sales. So pretty in line here with another major retailers here, right? So it does see that the total revenue will be down, and it provided here for looking into the final months of Lowe's fiscal year, which ends in January. Lowe's says it sees overall revenues of 86 billion, down from its prior forecast between 87 and 89 billion. So you see the guide down for Q4 as well. They do not expect the consumer to come back roaring in Q4 and make big ticket item purchases, unfortunately for them here. In the third quarter, the company delivered strong operating performance and improved customer service despite a greater than expected pullback in DIY discretionary spending, particularly in bigger ticket categories here. As we look ahead, Lowe's is committed to offering value and convenience this holiday season, helping our customers save time and money, said the CEO, right? So that is pretty much the gist of it for the large retailers, Home Depot and Lowe's. And Home Depot said the same, guys, right? Looking into the 2023 fiscal year, which ends in January, Home Depot also said that earnings would likely decline between 9 and 11% compared with its prior year forecast of a decline between 7 and 13% here. So both both of these retailers are telling you the same thing. Something that we've been mentioning on the channel for a while is that unfortunately the consumer is just out of discretionary spending money when rates are high. But Lowe's, in terms of their annual performance here, you can see that although 2023 is going to be a bit of a down year, 2024 as well, because rates are said to be high. Sorry, let me move my head out of the way. You can see this pull forward of demand here, 2021 and 2022, really a very big year. And now we have 2 flat fiscal years. So 2023 currently ending in January, and next year 2024 is said to be a bit flat on EPS as well here, but said to resume 2025 and 26. Big surprise, that's when rates will be pretty much back down to somewhat normal levels here. So that is the same thing for Home Depot. So we are going to get a bit of an EPS stall on Home Depot and Lowe's here. So Lowe's, I would be interested in playing this on the put wheel here, but I will be only interested if they really come down to the lower end of this range. Probably below 180 is where I would be interested. No red flags for the company as a whole. They are positioned fairly well in terms of their balance sheet and financials here. Just not a very good company. They're at the bottom of their cycle right now. Very cyclical company, guys. And company number 2 that we're going to be covering is Autodesk. Autodesk, I like them a lot, guys. Autodesk has been a company here that you can see are pretty much a ways away from their all-time high. As a matter of fact, specifically 42% off of their all-time high currently. And they're in a very nice accumulation range, as you guys can see, right? This whole 230 range all the way down to pretty much your 170 range is a very beautiful tight range here of accumulation. If we do come down, I have played this one a few times in the past over the course of this year. If we do come down, guys, below $200, maybe towards 190, I would be tempted to play this one again. No red flags for this one. I like this one, guys. If you don't know what Autodesk does, is they're pretty much a software manufacturer, kind of like Adobe, but whereas Adobe kind of caters more to retail, Autodesk is more in terms of business to business solutions. So they build a lot of software for companies, more specifically in engineering, construction, and other applications of the sorts, right? So they are just looking to help companies design large infrastructure projects, large architecture projects, and whatnot. And they sell software suites in order to enable companies to use them to design all of these large projects here that they have ongoing, right? So Autodesk has a very large suite of products. And a few years ago, as a matter of fact, 2016, 2017, they switched the revenue model similar to Adobe. They switched from a one-time purchase fee to a subscription model. And that is what has really allowed this company to become profitable over time. You can see the revenue has been steadily increasing here, and the revenue will continue to increase and continue to increase EPS. Look at this EPS growth forecasted here over the next couple of years. So 2023 already up decently 15%, and you can see it just keeps going out by about 15% on EPS every single year, 15 to 20%. So EPS will be growing for the company. It's going to contribute here to really bringing down this PE ratio a lot. So this company definitely representing some good value down here in these lower levels, and they do have a very efficient business model currently with their subscription services. You can see they've had no problem increasing net margins here. So let's take a look at their actual earnings per se. I do like this company. Their EPS had a nice little beat here of about 4%, and the revenue is up about 2% here. So let's take a look at what exactly happened. Autodesk earnings come in strong, an upbeat sign for construction here. So as I said, a lot of their products cater to construction, design software, right? Architecture firms, engineering firms, and the like here. So very good here. Autodesk earnings knows an indicator of activity both in construction and the overall economy. Came in better than expected while management increased its financial forecast for the January 2024 fiscal year. So very good, nice guide up for the next year here, guys. Very decent report by them as a whole, guys. They've been increasing profits over the course of this year, but their share price has remained fairly flat. So their PE ratio has been coming down ever so slightly. Now, the billings. Let's get into the billings real quick. Billings were $1.2 billion, down 11% from a year ago, but in line with street expectations. Now, the decline reflects the company's decision to shift customers to annual renewals from 3-year contracts billed upfront here, guys. So that's going to be a very good decision for the long term from them, but it means that billings are going to be slightly down on a year-over-year basis, as now instead of selling a 3-year subscription upfront, they'll only be doing 1-year rolling basis here. So expect a little drop on billings, but it doesn't say that the company is losing revenue. It's just a shift in the way that their billings are structured here. So Autodesk said revenue in its architecture, engineering, and construction segment rose 17%, accounting for a little under half of overall revenue. That is a strong result, is a positive sign about construction activity here, guys. So very good. They are a growing company, and I will show you here. This chart looks almost exactly like Adobe's when they made the switch. So you can pretty much see when they made their switch here in terms of EPS, right, and net income per share. So you can see when they made their switch from one-time sale to recurring revenue. And this is something that a lot of big companies has done. Microsoft has done this, Adobe has done this, and a few others, right? It usually always impacts the company positively. And now you can see that they're doing a very good job. Your net margins here were very, very low back then, and now their net margins are starting to get in line with what you would expect from a software company here, guys. So very, very, very good EPS expansion by the company here in shifting to a subscription model. I do like this company long term. It is a very, very good growth company in my opinion. Revenues continue to grow at double digits here, and EPS also continue to grow at double digits for the next 3 to 4 years. So no negative signs for Autodesk here, and I like this accumulation range that they're in pretty much as well. Anything below 190 pretty much would be a little add to the portfolio for me. Now, lastly, we're going to cover John Deere here. John Deere, we cover them every single quarter. It was one of my top 10 stocks in terms of value here, but you guys know that they are a cyclical company here. And cyclical, by cyclical, I mean they're heavily sensitive to interest rates. A lot of the products that they sell, $200,000, $300,000, $400,000, $500,000 tractors, are not going to be bought in cash by people who are in the farming and agriculture sector. They are going to be bought on financing. So now when you have financing rates between 6 to 11%, depending on your credit here, it's very tough for people to make those purchases. And John Deere, similar to Home Depot and Lowe's, this is what happened when you pulled forward a bunch of demand. As you can see, 2020 and 2021, lots of free money, low interest rates. They pulled forward a bunch of demand at everybody who was looking to buy or renew their tractors or farming equipment, right? They all did it back here. So they pulled forward a ton of demand in 2020 and 2021 here. And as you can see now, pretty much since 2021, their share price has been relatively flat, although they have managed to steadily increase revenue 2022 and 2023 as well. You can see this, they're up from 40 billion in end of 2021, all the way up to now 61.25. They just ended their fiscal year with this earnings right here. So now all the way up to about $61 billion in revenue. So the revenue has increased, guys, and their profit margins have increased from 13 to 16% as well, but their share price has remained fairly flat, which means their PE ratio is now at the lowest that it's been in a considerable amount of time. This company is very, very healthy. There is only one red flag in my opinion here, guys, and that is the fact that over the next couple of years, unfortunately, their EPS should be fairly flat as all of that pulled forward demand and slowing down on lowering of commodity prices, means that the agricultural sector will be making a bit less money. You guys know that when commodity prices were very, very high last year because of inflation, farmers were obviously able to get more money for the same amount of produce sold. Now everything is coming back more to normal stance now. So you can see John Deere is projecting here slight flat EPS here, but very, very strong EPS nonetheless here. As a whole, it's still significantly up from 2021 and 2022, almost about a 1.5x, right, from 2021, 2022, but slightly going to be diminished here from early 2023 when the last of those people made their purchases here. So John Deere, we can go into the earnings here, right? I do think it's a very decent value. This is my sweet spot right now. 358 down to 326 is an area that I would not mind picking up John Deere for the long term here. But just know that it is a very cyclical company. I like this accumulation pattern. There should be no reason why John Deere won't be able to surpass into the $400, $500 range here over the next couple of years here. So pretty much John Deere here, exactly as we said, Deere stock falls after the company crushed earnings. Here's why. We pretty much explained why, right? Because it's a very cyclical business here. Right? The guidance did not live up to the expectations here, right? So we'll get right into the guidance here, right? Deere stock was down 5.6%. Earnings didn't do it. It was the guidance here. Looking ahead to the fiscal year 2024, Deere expects to generate a net income of between 7.75 and 8.25 billion. Wall Street is projecting a net profit of 9.3. Okay, but Wall Street expected a decline from 2023 full year net income of 10.2, reflecting a concern that farm incomes and prices for agricultural products have hit their peak. A decline appears to be coming, and guidance wasn't able to live up to analyst expectations. You can see this right here. Corn and soybean prices are down about 29% and 4% respectively over the past year. Farm income here is projected to be 141 billion in 2023, according to the US Department of Agriculture, down from 183 billion in 2022. But this is still the second best year on record, guys, here. So you can't really say the 141 billion figure would be the second highest reading on record. And as you can see here, most dealers expect 2024 to be a down year. He visited several Deere dealers recently, All in, the takeaways were largely consistent with our expectation. There is more caution in the outlook, but it resembles more of a soft landing at this point here. Deere tends to guide conservatively. A year ago at the start of 2023, they told the market to expect a net income of $8 billion to $8.5 billion, but management raised that call a couple of times throughout the year. So it might just be a question of them guiding a bit lower to potentially be able to beat. But as I said, the value of this company is very, very good. They're not going to be falling that much in terms of EPS at all. I showed you guys they should be relatively flat. PE ratio is very, very attractive, more attractive than it has been in the past few years. And like I said, there should be no problem for this company to expand in the next 6 to 12 months. This company is sensitive to rates. So potentially when rates do start decreasing next year is when you may get the final breakout of this stage to the upside here, guys. So that's pretty much everything I had for you guys for earnings today. Now let's get right into our technical analysis of our major indexes. But you guys we'll see, we're going to do it fairly quick because nothing much has changed here, right? And tomorrow is a holiday. So guys, 1, 2, 3 legs up on SPY. We are still on leg number 3 here as the bulls continue to expand on the price. Still looking for resistance here, 459.27. And as I've been saying for the past couple of videos, guys, the bears can't crush this 12 EMA from the bulls. The bulls remain in complete control here. Yes, you have a tiny little bit of a rising wedge here, right, guys? That's the only red flag that I do see is there's a little bit of a rising wedge in formation here. But until the bears put in significant moves to the downside here, crush this for the 12 EMA in the 4 hour, and really put in some hour downtrends. We were talking about this yesterday's video, right? Can they set the 1 hour downtrend? Nope, bulls just ran with it again today here. So as long as that doesn't happen, SPY bulls remain in full control. Any pullback at this point is for a daily higher low above 448. And we're still looking for the potential top of this weekly move. But until we get some further daily consolidation, the weekly move is not done. QQQ, same thing as well. QQQ still hitting a new 52-week high today on the day, right? All the way up to 392. I'll remind you, QQQ now, the only resistance remaining is your all-time high 405, 406 levels. So we'll see if we can crack that. 400 psychological, going to be a big one as well. But bulls in full control, 1, 2, and now we're in your third leg again. So any consolidation here is going to be for a daily higher low above 383. For further uptrend here, we'll see if they can continue to rise or if all they get is 3 legs before a bit of daily consolidation. That would mean weekly consolidation as well. Tons of space for a pullback here and further price increase into the end of the year as well. So bulls in full control. If you're a bear and you want to see the bears gain momentum, need to see a loss of the 12 EMA on the 4-hour chart, and they need to set an hourly downtrend. They had the potential to set it into today's trading, but boom, the bulls are back here. No hourly downtrends in sight and no loss of the 12 EMA on the 4-hour chart. So bulls remain in full control. XLF financials here, same thing. XLF financials doing a very good job here today of pulling up 0.4%. Now XLF financials are coming into the top end of resistance here. 3550, 3560 is going to be the one to watch here. Tiny bit extended on the RSI as well here, guys. But same principle, no loss of the 12 EMA on the 4-hour and no significant hourly downtrend. You can see every time they try, they get shut down by the bulls and they just rise. So if you're a bear, you need to see all of these major sectors start losing your 12 EMA on the 4-hour and start losing the hourly trends. Then only then will you have daily consolidation. Bulls with tons of space to consolidate here. Any move down for a daily higher low for further price expansion. At this point, if you come a bit lower, target this area as your whole area of support. We're talking anywhere between 35 to about 3450-ish. This whole range right here should be very, very decent support for the bulls to pull into. And you do have your 12 EMA right there. So keep an eye on that if the bulls run out of steam soon. XLV Healthcare pulling up nicely again, 0.48% to the outside. Now really getting the daily uptrend momentum, guys. This is exactly what you want to see. Daily uptrend confirmed, running into a bit of resistance with the 200-day moving average here as well. And then you have your overhead horizontal resistance here at around 132. This whole area right here is going to be the area for resistance. But as soon as the bulls pull back, guys, just looking for a daily higher low. Anything pretty much above 124.60 is going to be for a daily higher low. Target this area right here, 129. You got your 2 moving averages right here. You have horizontal channel here of previous resistance, which will now be acting as support. So target that area as soon as your bulls are done. And same principle, you will see this as well. No loss of the 12 EMA on the 4-hour chart and no hourly downtrend in sight since this most recent move up, right? Bears have just not been able to get it done and now are getting completely steamrolled by the bulls. And on the weekly now, healthcare is looking very nice, guys. Engulfing move on the weekly. So any weekly pullback, weekly higher low for weekly uptrend change. Everything's the same. need to confirm the weekly uptrend. SPY, need to confirm the weekly uptrend on QQQ, need to confirm the weekly uptrend on XLF, and so on and so forth. You guys know, so we're just waiting for eventual pullbacks, but just to confirm weekly uptrends, guys. So bulls in control of everything now. IWM Russell doing very, very good as well. IWM up here 0.63% on the day, just maintaining here at the highs. Really nice tightening range here at the highs. You can see this better on the 4-hour time frame. Tesla used to do this all the time before breaking out higher. So this is a very, very nice bull flag here, guys. Consolidating at the top, nice little 1, 2, and now consolidation at the top here, refusing to come much below this 175 area of previous resistance, which is now support as well. You have your moving averages down there as well. So as long as the bulls maintain this level, I don't see a reason why they shouldn't be able to really smash this to the upside unless we get a further pullback here on our major indexes here. But everything looking very decent for the Russell here, guys. In terms of the weekly as well, we are finally starting to engulf more and more of this move. Any pullback, I'll remind you, will be for a weekly higher low, for a weekly trend change here. IWM Russell still significantly off your all-time highs. So it is definitely one of our laggard sectors here, guys. This is one of my best sectors here that I'm looking to pick up here once we get our weekly pullbacks on SPY, right? I'm just looking for a weekly pullback on SPY. That is when I'll be going a bit harder here on names, on growth names from the Russell, just waiting for that pullback currently. But now bulls are set up very, very, very beautifully here. Nice little tightening range here. So we will see which way it breaks. But as of now, with bulls in full control, the lean is obviously bullish bias. Now Dow Jones, very healthy move by the Dow Jones, if I do say so myself, pulling up into our area of resistance here, 35,350 all the way to 35,600. That's going to be the area to watch here. So Dow Jones also on leg number 3 here. Bulls are in full control. Any pullback is just going to be for a daily higher low. Keep an eye, 34,827 is your last area of higher low. So if we pull back and potentially lose that, your daily consolidation is underway and your weekly pullback will be underway as well here, guys. But everything looking very, very healthy for the bulls. They are smashing completely everything. If you pull back, guys, there's a very, very beautiful area now of support going to be in this whole area here. Going to be very tough for the bears to get through that area. So if we do pull back there, guys, pretty much targeting your moving averages at this point, right? Everything's looking very good. And even on the weekly, any weekly pullback is for a weekly higher low for further trend continuation at the end of the year. Dow Jones, no red flags whatsoever. Bulls in control of everything. Now let's move down to our big tech. So big tech, Apple, same situation as the rest here. Apple continues its meteoric rise to the upside, but you can see the last few days, Apple has been relatively struggling here with the price action, not able to maintain gains like this. So it's kind of tapering off at this point, but still no red flags. Slightly overbought here on the RSI. That's a tiny little red flag if you want. On the weekly, bulls are looking so strong if we do pull back weekly higher low into weekly trend change towards the end of the year here. But similar to the rest, guys, you can see it's curling off, but there's no reason that Apple can't just consolidate sideways, bull flag this, and just rally to the upside here. That is another potential. Don't need to see a significant drop. But if we do get a drop, guys, I'm targeting this area, you guys know, around 187, 185 is a likely area of pullback if we drop fairly hard here. 12 EMA on the 4-hour time frame is your guide. The bears are not able to gain any momentum breaking that. An hourly downtrend is just unable to be had. Just keeps getting rejected by the bulls every time they try it here. So keep an eye on those two things for Apple if you do want to see the bears start to make some momentum to the downside here. But I will remind you, any pullback is just for a weekly higher low. Apple looking very, very healthy. Any dip like this, I'm 100% buying on Apple. Now, AMD, give me a quick second here, guys. AMD also looking very healthy. I'm almost up about 3% here today. So AMD pulling exactly what I said is possible on Apple, right? Could just consolidate sideways for a bit. You saw this, right? Curling off, consolidate sideways, and then boom, you get another leg up here, right? So AMD doing very, very good. Currently still battling with a bit of the tail end of the resistance, 121, 122. And then we're all the way up, guys, into the 128, 130 area. So AMD very, very, very good. They've been cooling off the lower time frames as they consolidated sideways, right? You can see this cooling off the RSI. RSI is now looking good on the 4-hour. They lost it yesterday, right? So bears have been able to flush it through for a couple hours here, right? But now every time the bulls just come right back and engulf them. So as long as you can't set a 4-hour downtrend, or at least more than this, a 1-hour downtrend at the least, right? Tried here, no 1-hour downtrend confirmation. Tried right here, spiked down in pre-market. Bulls said no as soon as the market opened and just reversed it into a new hourly uptrend here. So bulls in full control here, guys. As soon as this move tops out, let's say they start losing it in a more convincing fashion here. As soon as it tops out, we are just looking for a daily higher low. Anything above pretty much 116.50 at this point is going to be a new daily higher low, and just looking for your weekly pullback as well here. Any weekly pullback on AMD, I will be buying 115 down to 110 is exactly where I want to be looking on this. Bulls in full control. Now Amazon, same thing. Bulls are in absolute full control. Consolidation sideways, cooling off the lower time frames. You can see this. So bulls, beautiful third leg up here as well, and they controlled the 4-hour time frame beautifully. It used to be overbought, but now you can see trending towards the downside as we get sideways consolidation. That's the best case scenario for the bulls. Now you can see yesterday's price action tried to lose the 12 EMA, now back above it. So look at these 12 EMAs on everything. Indexes and big tech, everything is the same at this point. Just looking for an eventual further daily consolidation, which would mean potential weekly consolidation as well. If Amazon pulls back, expect them to pull back a bit further here into the 140, 138 range. That would be a likely area for Amazon. Right, anything above 139.76 at this point, just going to be looking for another daily higher low. Can continue to tighten up here in a tightening range. That would be a bull flag, you know, or we're looking for a break, obviously a break of your new high today, right? 147.43 is just going to be a new break to the upside here. Bullish continuation on this beautiful daily uptrend continuation pattern here, right? So beautiful work on Amazon. No red flags whatsoever. Bulls control absolutely everything. Now moving down to Google. Google pretty much pushing 140 today, right? So Google continuing 1, 2, and now Google as well on its third leg up here. So looking very, very good. Any pullback above 135.42 going to be for a new daily higher low here. Looking very, very healthy. Google coming into resistance, obviously 142 down to about 141. This whole previous 52-week high is going to be the area here. They have now completely reversed all of the negative move after earnings, guys. So great recovery, V-shape on the weekly by Google. I'll remind you, any pullback on the weekly, just going to be for a higher low. Anything above 121.40, going to be for that higher low for further price expansion on Google at this point. So nothing to say, guys. Everything is the same. You guys know the drill. 4-hour, 12 EMA is going to be your guide. They can't do it, can't break the 12-hour EMA, and if they can't set an hourly downtrend, if the bulls keep doing this, guys, their bears are not going to get any momentum whatsoever for a few days in a row of pullback here. So keep an eye on those two indicators running up into resistance now. So we'll see how they deal with that. Excuse me. Now moving on to Meta. Meta performing beautifully, again up 1.34%, new 52-week high on the day, and Meta, same principle, 1, 2, 3 legs up at this point. So daily looking very healthy for the bulls. Any pullback above 133.26.52 is going to be for another daily higher low for further upside continuation here. Watch this level, guys. It's the previous 52-week high levels, right? It came up a few times. So if we do pull back, keep an eye on your 325-ish area. That's where bulls could pull back to if we get a few extended days of consolidation. And if we do get those few extended days, well, it's just going to look like a weekly bull flag here. Any pullback on the weekly is for dip buying on Meta as well for your little weekly uptrend continuation here. So very, very good job by Meta bulls. No red flags whatsoever. New 52-week highs. And as a whole, guys, Meta is now pushing up monthly trend as well. Next areas of resistance, 353, and then your all-time highs, 384. So looking very, very, very beautiful on Meta. Microsoft as well, etching out a new all-time high today. Ever so slightly here. Pushing up to almost 380 today, guys. Absolutely monster move by Microsoft. No pullback in sight here. Even on the red days, guys, it's still moving. It's still pushing higher highs, even on the red days, right? So very, very beautiful price action here by Microsoft here. Getting a bit lofty still on the daily as well. And on your 4-hour, at least they've chilled out a little bit. You can see this curling action as well. They've really done a good job of cooling off the 4-hour, but your daily is still a bit extended. So the same thing applies here, guys. Any pullback pretty much above 367 is just going to be for a daily higher low for further continuation of the upside. If we do get a few more days and lose these daily higher lows, well, your weekly uptrend is just going to have a little bit of weekly consolidation and before a further move up in Microsoft. No red flags whatsoever. Bulls are in absolute complete control. Once again, 4-hour time frame. I'll sound like a broken record. The bears can't put in significant downside here below the 12 EMA on the 4-hour time frame. They're just not going to get any momentum. And if we can't persist in hourly downtrends is step number 1, right? They've had a few in pre-market, but look, when the market opens, just boom, the bulls just smash it, right? So bears are not even able to set hourly downtrends properly. They just continuously get engulfed by the bulls. Bulls just buy every single dip, right? At this point, guys, we need to see your hourly trend change to the bears first. Then you need to see, can they persist that with a loss of your 12-hour? And only then can you get extended daily consolidation, extended weekly consolidation as well. Now moving on to NVIDIA. NVIDIA, after earnings today, down 2.46% here, but looking very, very healthy if I do say so myself. So we did smash our previous higher lows here, which were set at 482. As you can see, we smashed them a bit today, but ending a bit higher than that. So pretty much bulls were able to buy the dip, keep it over the 12 EMA here, and did a beautiful job here of reacting to the previous level here. 476 was a level, and look, they pretty much bounced off it to the dollar here. So very, very good recovery by the bulls intraday here today. You can see that as well, dipped on the morning and earnings, and pretty much rose through the afternoon here. So NVIDIA looking very, very, very healthy. If for ever which reason we lose the daily uptrend and set a potential daily downtrend here, well, you'll just be in weekly consolidation, guys, and the bulls have a lot of room to give. Anything above 394 is just going to be for a weekly higher low for further continuation on NVIDIA here. Anything pretty much the 470 range is going to be where your bulls are probably going to step in. You have your 12 EMA down here at around 460. So 470 down to 460 should be your channel pretty much of support for your NVIDIA bulls. So I would be looking to that in case they continue to pull back here, but no real red flags as of yet here, guys. Just an obviously volatile day after earnings. We'll see how the price resumes. Friday morning, it's a half day, and then into next week. No red flags on NVIDIA yet. Now our three last ones here, Tesla. So Tesla doing a good job here, down pretty much 3%, but I say doing a good job, even if they're down here, doing a good job of protecting the price here, right? So reacting nicely from our moving averages here. When they try to get here, you can see this green line here is your 200-day moving average. Your short-term ones, the 12, which is the yellow line, and 26 are all down here, guys. The confluence of areas at 230. So it's going to be tough for the bears to break through that in one clean shot. 230 down to 210 is my sweet spot. Tesla still trying to resume the daily uptrend here. So anything above 226.84, just going to be looking to protect a slight bull flag here and potentially rise to the upside here. So we'll see if they can do it. The next upside target obviously is going to be the 250 to 255 range. Why do I want that? I'll remind you on the weekly, it would signify a 80% recapture of this move here. So get me up to about 250, 255, then the possibility for a weekly trend change is going to be more than likely for Tesla here. I need to see them defend 227. If you lose 227, unfortunately, daily downtrend would be set. So I need to see them either smash through these highs or at least protect this tightening range here, guys, above your 226, right, 227 area. If they do lose this, daily downtrend will be set. Then you'll be looking for weekly consolidation. Anything above 194 is going to be for a weekly higher low for weekly uptrend reversal here. So no red flags on Tesla as of yet, even though they had a significant red day today. And now lastly, Palantir and PayPal. Palantir here had another red day, but they gapped up higher, guys. You'll see that. They pretty much gapped up a nice from yesterday's close at least, right? They gapped up pretty much nicely here, about 3-4% almost to the most, and then they kind of lost it here, but Palantir doing a great job here of protecting the level here. The level to watch, guys, was always 1932, and you can see that the low of the day here today was 1933, so off by a penny. So they're trying to protect these higher high, higher low, higher high, higher low, higher high patterns here. This is the line to watch. If you lose this level, you will lose your daily uptrend and you open the door for bears to potentially set a daily downtrend here, but that's okay. The bulls have tons of space on the weekly to give. If you set a daily downtrend here, right? If you set a daily downtrend like this, no problem at all. The bulls have tons of space to give back, guys. Anything above 1450 is just going to be for a weekly higher low for further price expansion into the end of the year. If we do pull back that much, target your $18.50, $18 flat range. That's been the area that I've been kind of calling out here. So that looks pretty much something like this. This little area of of congestion right there, rather, right? So keep an eye on that. No real red signs in terms of Palantir just yet. They have pulled down significantly here over the past few days, but it's just much needed consolidation here, guys. They were overbought. Now they're no longer overbought. We're overbought on the short-term time frame. Now 4 hour is nicely cooled off here. And as well, they were very overbought after that beautiful day, pretty much Friday into those two beautiful day Fridays into Monday. And now the 1 hour is pretty chilled out as well. So we'll see if the bulls can maintain this area. They're still struggling to maintain the previous 52-week highs on Palantir here. And now lastly, PayPal. PayPal up almost 2% on the day. Decent little recovery by PayPal. This is exactly what I wanted to see here, guys, right? So daily uptrend. We're just looking for the daily higher low for further price expansion. So anything above 53.51 was your daily higher low. We will see if it is yesterday's trading here. So need to protect yesterday's low. 55.35 is the area to watch. I would like to see PayPal continue to recover and now smash 58.50 to resume this daily uptrend for leg number 3. $63. If you get us into the $60 range, I'll remind you that that will be a very decent recovery here in terms of the weekly time frame. Could set us up for a weekly trend change like we had back here in June and July. So that's what I'm looking out for on PayPal. But as of now, price is kind of muted. Just need to protect these moving averages a bit better. So we'll see what happens next week on PayPal, looking for further expansion to the upside. So that's everything I had for you in terms of today here, guys, right? So we will do the videos a bit long for today, so I'll keep the portfolio recap. Really didn't do anything here today, guys. So we'll keep the portfolio recap for Friday with the half day. I'll have more time. There's no earnings, right? And we'll do a little recap. Tomorrow, I'm going to do a video here on is big tech overvalued or not? So we're going to go through our entire list after this entire rally. I'm going to get some price targets and we're going to see whether it or not it's very overvalued with next year's guidance kept in mind here, guys. Okay, so keep that in mind. I hope you enjoyed today's video. If you did, consider dropping a like, consider subscribing to the channel. If you're new, we'd love to have you here. And as always, if you have any questions, feel free to leave them down below in the comments. Stock, options, macro news, anything you want. I'll see you tomorrow. Take care. Peace.